Portfolio Construction and Risk Management, Chapter 14, Portfolio Optimization, Section 4, Optimization Limitations. Mean variance optimization is elegant because it tries to find the best return for a given level of risk, or the least risk for a target return. The catch is that it depends on estimates for returns, volatility, and correlations, and those estimates are never perfectly known, so even tiny forecasting errors can lead to very different portfolio weights than the model suggests. The biggest problem is estimation error. Optimizers naturally lean hardest into whatever asset looks best in the data, but they cannot tell whether that edge is real or just noise. That is why a model that seems mathematically precise can end up maximizing the error instead of the opportunity. That sensitivity often shows up as concentration and instability. A few assets with slightly better looking estimates can end up dominating the portfolio, even when the difference is not very meaningful. Then a small change in assumptions or sample period can trigger a major reshuffle, which also means higher turnover and higher costs. Risk can also be understated when we reduce it to variance alone. Mean variance methods work best when returns behave in a fairly normal, symmetric way, but real markets often bring fat tails, skewness, and sudden regime changes. A portfolio can look efficient on paper and still carry much more drawdown risk than the model captures. Correlations add another layer of uncertainty. Optimization usually relies on historical relationships between assets, but those relationships do not stay fixed over time. In stressful markets, assets that once looked nicely diversified can start moving together, and the protection you expected can shrink right when you need it most. There is also a practical mismatch between the model and real investing. Standard optimization usually gives a clean answer for one point in time, but investors live through many periods with rebalancing, taxes, trading costs, and liquidity limits. Reoptimizing again and again may look disciplined, yet it can quietly reduce the real-world benefit. So the best use of optimization is usually as a starting point, not a set of exact instructions. You can estimate inputs, run the model, and then test how sensitive the results are to small changes. After that, judgment matters. Check diversification, turnover, costs, and whether the portfolio is actually practical to hold. A simple example makes the point. In one 5-stock optimization, Amazon received nearly half the portfolio, while Apple got a much smaller weight. Then a modest shift in the sample window pushed Apple to the top instead. The businesses did not change nearly as much as the weights did, which tells you the model was reacting strongly to the data period. That is why robustness matters more than precision. Exact-looking weights can create false confidence, especially if they come from one historical window and ignore costs, liquidity, or hidden concentration. In practice, a portfolio that holds up reasonably well across different assumptions is often more valuable than one that looks perfectly optimal in theory.